So using the corporate cost of capital, basically what we're going to use is it establishes a benchmark rate of return that we're going to use to evaluate new projects. The rate is used regardless of how the new project actually will be financed. In other words, there may be a new project that a healthcare organization is considering that's going to be entirely financed with debt. So why would it be wrong to just use the cost of debt to evaluate that project? Keeping in mind that management, in the previous example, we had a 35% target for debt and a 65% for equity. If we finance one project entirely with debt, what will happen to that target?
It will change.
Yeah, you either move closer to it or farther away from it. So what would happen if you evaluate a new project only with the cost of debt? What would you have to evaluate the next project with? Only cost of equity. So you, over the long run, you're really confusing the issue. You want to move towards a target capital structure, so you want to use the weights that are in the corporate cost of capital to evaluate all long-term projects. That's because that reflects the optimal capital structure you want to move towards and the relative optimal mix of financing sources. You do not want to evaluate project by project depending on how the project's financed. Would the same rate be applied to all projects? And the answer is no, because it assumes that the projects you're going to be using it for are all of average risk. If they're not of average risk, what do you have to do?
Adjust for the risk.
And how would you do that?
Adding a risk premium.
Yeah, you can increase the or decrease the corporate cost of capital to adjust for relative changes in risk. So if you've got a project that's very similar to your existing line of business, or even then you might want to use the corporate cost of capital for that project. If you're getting into a new market or a new product line or new kinds of services, you may want to increase the corporate cost of capital because it's greater risk. So that's essentially what we're doing here. The average for this organization, the corporate cost of capital 11.2%. That's the rate we would use for a project of average risk. At the low risk, we would reduce the corporate cost of capital, and the higher risk, we would increase it. Flotation costs on equity tend to be fairly significant compared to debt. There are two ways you can adjust the cost of equity for issuance costs. You can adjust the project cost. In other words, add the increased cost of the flotation cost onto the cost of the project, or you can adjust the cost of the equity, which produces two costs, one for retained earnings, one for new stock sales. We will ignore equity issuance costs, except we won't in any case today. It's just to give you some practice. The rest of the course we will ignore. Divisional cost of capital. Often large organizations have got different divisions that operate in very different business lines, different markets. GE, for example, is in electric generators, it's in computers, it's in leasing, it's in all kinds of different companies. They will often have different costs of capital depending on the division. And again, the corporate cost of capital within each division will be based on the average risk of the division. Even within the division, they may adjust their cost of capital up or down depending on whether the project is riskier or less risky than their typical project. So to conclude, this is a fairly important discussion. What factors influence a business's cost of capital? I mean, at any point in time, a business may have, a not-for-profit or for-profit may have a corporate cost of capital 6%, 2%, 10%. So what determines where that level is at any one point in time? Well, there's external factors and there are internal. External factors are factors that management can do nothing about. And of those four things that are listed there, the level of interest rates is probably the most important. It probably has the greatest effect on the corporate cost of capital at any one point in time. So when globally, when interest rates tend to go up, they tend to go down, all over the world, organizations, for-profit and not-for-profit, their cost of capital go up and down in response to those changes in global interest rates. Tax rates. There's not much an individual organization or corporation can do to change their tax rate. I mean, tax rates are the way they are. They're set by government. And therefore, they are an important influence on the corporate cost of capital. What happens if the tax rates go up? The corporate tax rate goes up. What happens? Cost of debt goes down. Why is that?
Because we adjust it for 1 minus the tax rate.
Because we're multiplying it times 1 minus the tax rate. So when corporate tax rates go up, the cost of capital essentially goes down because there's more interest being sheltered by the tax code. What happens if personal tax rates go up? We're going to talk more about that in capital structure, but right now, just think through, if you're Chris Ellington at UNC and the government increases all of our tax rates, how will that affect him? Not him personally. How will that affect UNC healthcare?
Would the return on the market go up because more money is being taken from dividends or whatever you're earning on your stock investment? So then the return would go up, and then the cost of equity should go up.
Okay, let's reverse that. If I'm an investor and I'm thinking of buying UNC bonds, I'm just Joe Blow thinking of buying some UNC bonds, and the government increases my taxes, will that make me more or less likely to buy tax-exempt UNC bonds? More likely. Why?
Because if you buy for-profit, you will be paying taxes. If you buy not-for-profit, you won't pay any taxes.
Exactly. So when taxes go up, all the not-for-profits go hooray, because that makes their debt more appealing to investors. Because the after-tax, in comparison to the for-profit bonds, there's a bigger gap between the after-tax and the tax-exempt rate. So they can actually offer a lower rate when tax rates go up. Okay, any questions about the corporate cost of capital at this point?
You're saying that not-for-profit bonds can offer a lower interest rate because they have a higher demand?
That's right, because if personal tax rates go up, that means the relative proceeds to an investor buying a for-profit bond go down, and therefore they can lower their rate as well. Okay, let's try a few practice problems. Is this true or false? It's true. Different kinds of projects may have different kinds of risks. You have to adjust the corporate cost of capital to reflect those risks. Which of the following statements is correct? B is the correct answer. Retained earnings are not free. If you do nothing with them to them, there is an opportunity cost. True or false? That's false, because you want to move towards your target, as we talked about earlier. Okay, let's